Hi, I'm Jimmy. In this video, I'm walking through the 5 companies that I think could do well as the future of the stock market and the economy become more uncertain. So to pick these companies, I focused on companies that had a decent balance sheet and solid profit margins, thanks at least to some pricing power. I believe that this should allow for these companies and companies like them to do well if we do see a downturn in the economy, and this could allow for us to use any volatility like we've been seeing lately as an opportunity to get strong companies at a better price. Okay, so let's set the stage. Clearly, the market has seen some turmoil recently. I'm sure we've all seen it. We have big up days, we have big down days. It's been all over the place, and frankly, it's been quite interesting. So within this volatility, as I've been updating the research, as we try to build our portfolios from the analysis of our Dow 30 analysis, well, I've realized how important it is going to be for each of us to prep our portfolios for the possibility of a downturn in the economy and ultimately in the stock market. Even if it's not a crash in the economy, a simple pullback in the economy can do crazy things to the stock market. So when I look for companies that can outperform in this type of market, well, I want to focus on companies that can maintain better than average earnings per share. Even if earnings per share's growth were to slow, I would expect these companies to do better than the market averages. Okay, so here's my logic. So this is a chart of the S&P 500's earnings per share going back to 2001. And as we can see, it's been on a nice run just recently. Now, right in this area here, well, this is where earnings per share was flat for a little bit. At that time, earnings per share for the S&P 500 was about $106 per share. Then it went on a nice run, and most recently, earnings per share is about $153 per share. So now if we were to overlay the actual price of the S&P 500 on top of earnings per share, we can see how much they act alike. Probably no surprise there. Earnings acts a lot. Earnings drives the price. We get it. Okay, so now our question is, are there any warning signs that tell us where things might go? Now, if we were to swap out our original earnings per share chart and we were to replace that with earnings per share growth, the growth rate on a percentage basis. So now these bars are showing the actual percentage growth rate of earnings per share on a year-over-year basis. So this bar right here, well, this bar represents the first quarter of 2019, the last day of the first quarter. What were earnings per share then? And we compare it to the end of the first quarter of the previous year. So right now it's $153. Back then, it was $135, so that's about a 13% growth rate. So when we look at this chart, we could see that earnings per share has grown each quarter for the past few years, and then recently we could see that earnings per share growth on a quarterly basis has started to slow. Now, it's important to remember that we're talking about a slowing of the growth rate, not a negative growth rate. So it's just growing at a slower rate than it was before. Now, just because it's slowing doesn't necessarily mean that the stock market will do bad. If we look at this area, well, growth slowed and the stock market continued to climb nicely. But when growth went negative, well, the market was generally acted differently. That was true here, here, and here. Now, in that last example, well, the market actually was more flat to slightly up, whereas the first 2 examples, the market went down. But in that last example, the negative earnings per share growth was less than the first 2 periods. Now, I bring this out not because I am trying to predict where the market is going to go, but mostly because I wanted to identify the periods where this type of slowing happened, and I wanted to look at which companies performed the best during this time period. And that brings us to a few of the key characteristics that I think are important. So we're looking for companies that are growing their revenue and have strong pricing power. We can usually identify pricing power when we look at profit margins. So ideally, we're looking for companies that have relatively stable profit margins. Then in theory, if the economy struggled, they would have the strongest chance of keeping their numbers at least respectable. And then I'm looking for companies that also have a strong balance sheet. Now, to identify the strength of the balance sheet, basically what I did was I focused on companies, I looked at their debt and compared it to their cash, their short-term assets, their annual revenue, and I tried to keep in mind their margins because in theory, all we're really worried about is their ability to pay off the interest and ultimately the principal of that debt. So even if you don't like the companies that I talk about, well, I suggest you keep in mind the power of strong margins and good balance sheets whenever the economy is looking at slowing growth. Okay, now let's move on to the companies. So I'm going to touch briefly on each of the 5 companies that I like, but I'm not going too deep because I don't want this video to run for too long. So if there's any of these companies that you want me to run deeper on, let me know in the comments below and I'll be sure to do that. Okay, so the first company is Waste Management, ticker symbol WM. Now, Waste Management provides services around the collection and transfer of waste. They also do some recycling, and they operate some waste to energy facilities. And as we could see, they have grown their revenue quite consistently since about 2015. Now, the green bars are analyst expectations, and as we could see, analysts are expecting them to continue to grow their revenue at least at a decent pace for the next few years. Then, when we switch over to net income margins, well, here we can see that net income margins have improved and are expected to stay fairly stable over the next couple of years. Now, Waste Management has about $10 billion in debt, and they have about $15 billion a year in revenue as of about last year. Now, this is a bit higher than I would have liked, but Waste Management has had this level of debt for a long time, and it hasn't slowed their growth much at all. So if the economy does slow, and it seems like earnings per share from the charts that we're looking at for the S&P 500 seems that the EPS charts are in fact slowing, well, I would expect for Waste Management's business to continue to do well, or at least better than the broader market. Okay, the next company is Union Pacific, ticker symbol UNP. Now, Union Pacific is a rail transportation company. They ship chemical, agricultural, automotive products, and a handful of others around the United States. They're one of the larger rail shipping companies in North America. Now, this is a chart of UNP's revenue going back the past couple of years. And as we could see, revenue has been growing nicely, and analysts are expecting it to continue to grow. Now, when we switch over to net income margins, well, net income margins have been largely stable if we ignore this giant pop in the middle and during 2017. Now, 2017, that pop happened because of the deferred tax benefits that came out of the tax law changes in the United States. So ignoring that pop, what I like most about this chart is before that pop, well, margins were, let's say, in about the 20% range, while it seems like margins after that have been north of 25%. So that's only true if we believe analyst estimates. Either way, it seems like a pretty good thing. Now, one negative for UNP stock is that UNP has more debt relative to revenue than any of the other companies on our list. So as of the end of the last quarter, UNP had about $27 billion in debt. And that's compared to about $23 billion in revenue. Now, when I dug into why they issued more debt in the past quarter, well, their answer was at least partially to buy back stock. And I really didn't like that answer. Now, despite my disliking this answer, I actually don't think that this is too much debt for Union Pacific to handle. And as we can see with profit margins, well, they have more than enough incoming profits to support their debt and probably a lot more. That being said, I figure UNP stock will probably do a good job of outperforming the economy on an earnings per share basis and likely on a stock basis if the economy struggles. Okay, up next, I'm actually going to do two companies at the same time because they're similar, and I really like both of them. So the first one is Home Depot, ticker symbol HD, and Lowe's, ticker symbol LOW. Now, if I was really pressed to pick my favorite home improvement store chain, well, I shop at Lowe's, so I really like what they offer, and I'm between about a Home Depot and a Lowe's, about the same distance to both. But from an investment standpoint, I actually like Home Depot better. So this is a chart for both Home Depot and Lowe's revenue. And as we can see, both Home Depot and Lowe's are expecting continued growth. Now we can see that Home Depot has better margins than Lowe's. And although it seems like analysts are expecting margins to level off in the next couple of years, well, Home Depot still looks to be better than Lowe's in the coming years. Now, Lowe's has about $16 billion in debt compared to the $71 billion in revenue, while Home Depot has about $29 billion in debt compared to the $108 billion in revenue. Now, technically, we really shouldn't be comparing debt to revenue. We really want to compare it to earnings before interest and taxes, but we are also including margins in all of this. That's why, if you're wondering why I'm using revenue and not EBIT, well, I'm using revenue because we're also including margins, so net income margins. Therefore, we're able to calculate whether or not they'd be able to pay off this, any added interest expense. The fact that they have solid net profit margins implies that they can handle the debt that they have. That being said, I completely understand if this level of debt bothers some people. That's why I spent so much time with the premise of what I was after. That way you could pick your own if you wanted to. But this leads us to our last company, my favorite company on the list, Microsoft. Ticker symbol MSFT. Microsoft is a manufacturer of computer software, video game consoles, computers, and a handful of other technology-related products. Now, Microsoft does have about $86 billion in debt, And when we compare that, sticking with the same analogy, we compare that to their revenue of about $110 billion, which is what they put up in 2018. But their $86 billion in debt doesn't bother me at all, since Microsoft also has about $131 billion in cash and short-term investments, which means that they have enough cash right now to pay off all of their debt today if they wanted to. That's a good position to be in. Now, when we look at this chart of revenue, we could see that revenue has been growing fairly nicely in the past couple of years and is expected to continue to grow in the next few years. Then when we switch over to net income margins, well, net income margins once again look very stable. And overall, my general belief is that anytime you see net income margins north of 20%, things are looking fairly good for that company. So those are the 5 companies that I think could do well if the economy struggles. Which companies do you like? Do you like any of these companies here? Do you have a different company that you like? Let me know what you think in the comments below. Thank you for sticking with me all the way to the end of the video. If you haven't done so already, hit the thumbs up, hit subscribe. I'll see you in the next video.